middle half of chapter 8, which is the last chapter we're doing, and we're doing the middle half, which is about inventory methods or cost flow assumptions. Last time, I wanted to make sure that we hit this because we kind of ran through this at the end, but we talked about what items to include in inventory. So in general, in inventory, you include the cost to get the inventory there. Just like for fixed assets, you include in fixed assets everything to get that the item in condition for use. For inventory, it's kind of the same thing. So freight charges, cost of acquisition, and labor and production costs are all included in the cost of inventory. And so those are product cost. Product cost are the cost to make the product, and they stay attached to the product in inventory on the balance sheet until you do what? When does it leave inventory? When you sell the product, right? Okay. And then it goes to cost of goods sold on the income statement, right? Okay. So those are product costs. They included in inventory is direct materials, direct labor, and manufacturing overhead. Those are the three kinds of manufacturing cost, right? And then period cost are costs that are assigned to the period and not the product. So the primary period costs are selling and administrative expenses. Okay, so I just wanted to make sure we got that because I'm not sure how hard we hit it. Okay, so we're going to start on page 428, and we're not going to go through PowerPoints. I just printed out slide 31 out of the one PowerPoint. So we're going to kind of focus on this slide, okay? And we're going to go over 4 cost flow assumptions, okay? So in other words, how do we measure the cost of the inventory and the cost of goods sold, okay? So remember we had this formula where beginning inventory plus no. What's our formula here? Beginning inventory plus purchases equals what? Goods available, and that is either going to be goods available is either going to turn out to be sold or not sold. So what are those two things? Yeah, cost of goods sold or ending inventory. Okay, so this is our formula. Beginning inventory plus purchases is goods available for sale minus cost of goods sold equals ending inventory, right? Or it could be minus ending inventory equals cost of goods sold, okay? So that's the formula we're going to work with today as we go through these cost flow assumptions. And what we mean by the cost flow assumptions is how do we assign cost to either cost of goods sold or ending inventory? We know what the cost is of beginning inventory and purchases because we paid for the purchases. So we know what goods available for sale is, but we have a choice as to how we assign cost here. And companies can adopt one of several different cost flow assumptions, but we're going to talk about 4 of them today, okay? Okay, so the first one is the specific identification. The specific identification method. Okay, so what the specific identification method is we know which one of the items we sold. Okay, so like right here in cost of goods sold, we know which items we sold in cost of goods sold, and we know how much that particular item cost. So what kind of goods do we usually keep up with the cost of each item? Not really toothpaste and shampoo. We don't usually keep up with small items like that. We usually use the specific identification method when we have costly items and a few costly items, okay? So we don't have very much product, and we don't have, and each one costs a lot. So an example of those would be cars, diamonds, airplanes, things like that, okay? Where we keep up with the cost of each one. All right. The next one is average cost. Okay, so average cost, we know, we come up with goods available for sale, and then we say, okay, here's our total cost for our goods available for sale, and here's how many goods we had available for sale, and we just divide it out and get an average. And every item gets the same cost. In cost of goods sold and ending inventory, they get the same cost, okay? So we use that maybe for items that, let's think about maybe we use it for things like cotton, cotton by weight. Every little pound of cotton looks the same as every other little pound of cotton, right? So something or cereal, where things just all look alike. We don't need to differentiate between them. And we just have a lot of homogeneous items. Okay, so what we're going to do is go through our example here using our cost flow assumptions. So on this slide, slide number 31, we had well, here, let me move this down here. We're going to see beginning inventory plus purchases is goods available. Then we either sold them, let's call that cost of goods sold and ending inventory. Okay, so let's see how many goods we had in this. Let's come up with this formula just for numbers. How many goods did we have in beginning inventory? This isn't all that clear. That first one is beginning inventory, 2,000. Okay, do you see what I mean? That first one really should be beginning inventory. 2,000 goods in beginning inventory, and then we purchased 8,000 for a total goods available of 10,000. Do you see where I got that on that slide? We had 2,000 plus 6,000 plus 2,000, so we had a total of 10,000 goods available for sale, okay? All right, how many did we sell? 4,000, okay. What's our ending inventory? 6,000. Okay. All right, so we had 6,000 in ending inventory. Now what we want to do here, okay, let's figure out what our goods available for sale was in dollars, okay? We had 2,000 at 4 for a total of 8,000. We had 8,000 purchased. What's the total of that? Let's see. Purchases. Well, they've got it added up down there. So goods available, see theirs down there is 43,900. All right? So do you see, this is what we're trying to allocate. We had 10,000 units available, and we had a total of 43,900. Now, under any of the cost flow assumptions we use, our cost of goods sold and ending inventory is going to add up to 43,900. Okay? Do you see what I mean? No matter if we use specific identification or average cost, these two items here are going to add up to 43,900. Those are our total goods available for sale, 10,000 goods. Okay? So now let's go through under several different cost flow assumptions, okay? So the first one that we're going to do is specific ID, okay? Now, let's assume that your ending inventory under the specific identification method is composed of these items. Oh, this one is 3. Okay, so we had a total of 6,000 in ending inventory, right? And let's assume that these were the 6,000 items. 1,000 that we had from March 2nd, 3,000 from March 15th, and 2,000 from March 20th. Okay, so what we want to do is, this is our ending inventory, number-wise. We want to come up with our ending inventory in dollars, okay? So how do we do that? We multiply this times their respective cost, right? So on March 2nd, those were at $4 a piece. On the 15th, they were at $4.40, and they were at $4.75 here. Okay? Do you see where I'm going with this? Somebody just told us these are the specific ones that are left in ending inventory. And so dollar-wise, our ending inventory is $4,000, $13,200, and $9,500 for a total of $26,700. Okay. So if our ending inventory is 26.7, how much is our cost of goods sold? Brett, how much is our cost of goods sold? Okay, so 17,200. So how did we get that?
Subtract the goods available for sale minus the ending inventory.
Yeah, this one. Okay, because we know that these two, ending inventory and cost of goods sold, add up to 43.9, right? All right, so does that make sense? Jeremy, are we there? Okay, so you can either figure out, okay, let's put it this way. Here we figured out ending inventory. Then we can automatically figure the other one out. In all these methods, you can figure one of them out and subtract to find the other one, okay? All right, so we're going to keep going here. Which one are we going to do next? The average. We're going to do we're going to do the average. So average cost, weighted average cost, whatever you want to call it. Okay, so how do we calculate the average? We take our goods available in dollars, and we divide by our goods available in quantity. Okay? So what is our average cost? Avery, you got it?
Is it the 43,900 divided by 6,000?
Well, no, because the 6,000 is ending inventory. We're doing our goods available in dollars divided by our goods available in numbers. Yeah, 10,000, which gives you,
4.39.
excellent. Okay, excellent. All righty, so we're doing $43,900 divided by 10,000 units to give you 4.39. This is our average cost. So, so our ending inventory is how much? Ending inventory is 6,000 units at 439 equals Brett. 26,340. All right. Then how much is our cost of goods sold? Jeremy, you're getting this one. Our cost of goods sold. How many items did we have in cost of goods sold? Up here. 4,000. Okay, so it's going to be 4,000 at how much? So under the average cost, we use that average cost for everything. 4.39, so which is a total of $17,560. Okay. All right. So does this and this add up to 42 like it's supposed to? 43.9? Okay. So see how these two things right here are supposed to add up to 43.9, right? And they do, right? Okay. All right, so that's average cost. All right, I feel like we're struggling on this a little bit. Tell me if we're clear or not. Kyle, how are we doing?
I'm fine. Just the specific ID. I was just confused at first on how we got the.
I told you that. Just somebody's going to tell you, here's the units left.
Yeah. Well, I was
Okay.
just confused. I was just confused at how we got the 17,200.
Okay, this one?
Yeah.
Yeah. Okay, so do you know now?
Yeah, I know.
Okay. Yeah, so we did 43.9 minus 26.7 equals 17.2, right? Okay, so that's that. What else are we missing?
So 6,000 is the average cost that came from the inventory?
Yeah, we already said ending inventory had 6,000 and cost of goods sold had 4,000. So when we're figuring out ending inventory, 6,000 times our average cost equals the dollar amount. When we're figuring out cost of goods sold, 4,000 times the average cost is cost of goods sold. Okay? So Avery, how are we doing? Anything confusing?
Just like at the very beginning, I guess we just assumed the last one's the ending inventory,
Oh, okay. So like on the sheet of paper? No. Where? Where are we looking? Oh, like on page 428?
yes ma'am, like that,
Okay. Yeah, the balance.
we just assumed that's the
Yeah, that's the ending inventory, 6,000. Yeah. Well, okay. So the reason I did this part first is because I think you should do this part of the problem whenever you read it. You should say, what are my number of units using this formula? I started out with 2,000 units. This 2,000, even though it says March 1st in their little write-up, they're treating it like the beginning inventory. Do you see what I mean? That's maybe one thing that's confusing about the slide. The 2,000 is the beginning inventory, and they're going to give you, the dollar amount for that. Then they have a bunch of purchases. Now this one, they only had 2 purchases, right? But you can see how confusing it would get if there were lots and lots of purchases. And so that's why I think it's easier to get these numbers right. Know that there were 10,000 available, 4,000 were sold, and your ending inventory was 6. Maybe we came about this, in the sold column it says 4,000, right? And the 6 is ending inventory because that's the balance left in inventory, right? Okay, so any other questions? I want to get this straight before we go on because it gets worse. More confusing from here. It's not really worse, but we're going to use the same problem. Jonathan, we're doing okay? Okay. Brett, good? Okay. All right. So now we're going to go on to, what are we doing next? Exactly. Okay. So now we're going to do FIFO. Okay, so what is first in, first out? What does that mean? We have first let me just say, why are we coming up with these cost flow assumptions? Let's just talk about that for a second. Apparently, we've got like at least 4 that we're going to talk about today. We're going to talk about at least 4 today. What makes us choose one over the other? It might be if we make airplanes, then we're just going to go with the specific ID. And maybe if we shovel coal, we're going to go with the average cost. But beyond that, why do we likely choose one over the other? Now, the cost of goods sold goes to our income statement, right? So if we take a high cost of goods sold to our income statement, what does that do to our income? Lowers it, right? Y'all are straight on that, right? It lowers your income. That's an inverse relationship, okay? Would we like a low net income? Wait, who said? No, we don't like a low net income. Because why? It doesn't look good, right? We're worried about appearances and maybe people would not buy our stuff as much. Now, so if we have a high net income, then what does that do for us? That makes us look good, but it also does what? High net income means high taxes. So are we worried more about how we look or how much taxes we pay? It could be, under some scenarios, some companies might be worried more about taxes than how it looks. Okay? So it depends on, a lot of times, so let's just rephrase that. A lot of times, companies choose their inventory method purely for cash flow reasons, tax reasons. Or sometimes they might choose it to make them look better. If they're struggling, a new company, yes, they might worry about appearances. If they're an established company, they're probably worried about taxes, okay? So a lot of times, companies choose their inventory method for these reasons. Now, what does that sound like to you guys? Does it sound like we're manipulating income? Yes, it does to me too. So this is kind of a problem with our, with the way that our accounting rules work, because they can choose which one to do and they can manipulate their income by their choice, okay? So I don't really like that so much. And inventory and cost of goods sold is a big number for companies. It's, very material. So it could be that later on these rules are going to change so that there's less leeway. But, so the reason I'm pointing this out is, what are we not deciding based on? We're really, in FIFO and LIFO, the last two that we're going to talk about, we're not deciding which one to use based on the actual flow of the goods through our company. We're ignoring which ones we sold first or which ones are left in inventory, and we're just pretending that certain ones were sold first. Okay, so FIFO and LIFO have to do with identifying which goods are going to be in cost of goods sold and which ones are in ending inventory. Imagine this as a grocery shelf. Cereal on a grocery, milk on the grocery shelf. Do y'all buy milk? What do you buy? Do you ever look at the date? Okay, like spinach, for instance. You know, which spinach should they put in the front for me to buy? The oldest. What do I do instead? I go all the way back there and get the one way back here, right? Okay, so I'm not doing what they're asking me to do. But imagine if I were a grocery store and I had a bunch of goods on the shelf. Under the FIFO method, the first ones in are the first ones out, all right? So y'all get this, right? This means first in, first out. First in, first out. What does out mean? Sold, right? So the first ones in are the first ones sold. So they want me to buy the oldest spinach, right? They want me to buy the oldest spinach, but I'm not doing it. I'm going and getting something else, right? Okay. So in FIFO, the first ones in are the first ones out. That makes perfect sense to me, that the flow of the goods might be something like that. The first ones that came in are the first ones that are going to get sold, that it's going to be the most recent purchases are going to be the ones in ending inventory. That kind of makes sense to me, although it's not like the grocery store example. But it kind of makes sense. Think about it like this. All year long, okay, all year long, the grocery store buys spinach, right? All year long, January through December, they're buying spinach, okay? Now, under FIFO, what happens? All of this early spinach is sold, and all of this late spinach is in inventory. That's under FIFO. Does that make sense? The first ones in get sold. Now, the opposite of FIFO is LIFO. Last ones in, first ones out. Now, so what does that mean? The last things in are the ones that are sold. These things are sold, and these things are in inventory. Now, how does that make sense to y'all? January spinach is the one in inventory. December and July spinach is sold. Do you see the weird thing about this? We're just pretending like the January spinach, at least this is the cost that we leave in inventory. And what normally happens in our price of spinach? What happens to our price of spinach? Up or down? Up. Price of everything goes up except for gas recently, right? I mean, mostly in our world, prices of things go up. You know, so which spinach, you know, this one usually costs more in December. And, you know, under these two different assumptions, either our ending inventory is going to cost more or our cost of goods sold is going to cost more. And do you see how that's going to affect net income a little bit? Okay, so in periods of rising prices, this one is going to have, LIFO is going to have a higher cost of goods sold and a lower net income. Does that make sense? This is like a crucial concept here, okay? So either, somehow or another, commit this to your mind bank, that in periods of rising prices, which is what we usually have, cost of goods sold is going to be higher under LIFO because we're using more recent cost to be cost of goods sold. And that makes net income lower under LIFO. Which one is the most popular inventory method? More companies use Jonathan's philosophy of let's make net income lower because that makes taxes lower. The big companies, okay, the big Fortune 500 companies, that's kind of their typical thing. Let's lower our taxes. Smaller companies, yes, they might go with we better look better, smaller companies. So maybe they go like that, or on the other hand, maybe every penny of taxes is important to them too. So anyway, that's why LIFO is kind of a more popular inventory method. All right. So, what is the actual cost flow of goods? Physical flow of goods, I'm sorry. The physical flow of goods, do you think the spinach is still there from January? No. Right? It's gone somewhere. And the weird thing is, under LIFO, when this spinach is still in inventory, that makes it in our beginning inventory, and it carries on over to the next year, right? The cost of it carries on over to the next year. And it still might stay there for years and years, as long as we have enough more recent purchases to go to cost of goods sold. Okay? So the spinach from 2 years ago could still be in inventory 5 years ago, which to me is just like this crazy accounting assumption. We're really just, this is like big time pretending to me. I don't like to pretend very much, But anyway, this is the way things work in the inventory world, okay? So now we're going to talk about FIFO. Okay, so the first ones, remember what we're working on is the ending inventory. We're going to calculate ending inventory. The first ones were the ones that were sold. The last ones are left in ending inventory. All right, so the last ones are left in ending inventory. So what do we have in our ending inventory? Avery, are you helping me here? Don't know. Which ones were the last ones? Oh, no, look here.
Last purchase,
Yeah.
the 6,000, 2,000?
Yeah, the 6,000, 2,000. So go down to the 2,000 one. Okay, we're going to start at the 2,000. Okay, so on March 30th, we had 2,000. This is left in ending inventory is what we're saying. At how much? How much was our 2,000 at?
$4.75.
$4.75 equals
$9,500.
okay. And then what else did we have in ending inventory? How many more do we need? How much? Okay, sorry, ending inventory. 4,000. Okay. So we need 4,000 because we had a total of 6,000 in ending inventory, right? Okay. Do you see where we're going with this, Avery? No. We had a total of 6,000 in ending inventory. So we used 2,000 from 330, from the most recent. Now, so the next 4,000 is coming from March 15th. And those were priced at, Avery,
$4.40.
$4.40. And so that's a total of
$17,600.
$17,600. So our ending inventory is the total of these two things, 6,000 items at 27.1, right? That's our ending inventory. You following this? Okay. Now we're going to try this one again. How much is our cost of goods sold? $16,800, because that 27.1 and 16.8 is a total of 43.9, right? Okay. I'm kind of not happy about how this looks over here. We're going to just move this. This looks sloppy, right? Okay, so this is 439. Okay, so you see how in this column we have ending inventory, and in this column we have cost of goods sold, right? And both of those add up to both of these things add up to 43.9, okay? And you're seeing how all these numbers are different. Like all the ending inventory numbers are different, all the cost of goods sold numbers are different, right? Okay? And now we're going to do LIFO. So what does LIFO mean? LIFO is last in, first out. And what does that mean? These last spinaches that we bought, these are the ones that go to cost of goods sold. Out is code word for sold, right? All right, so we're going to calculate ending inventory again. The last ones in are the ones that were sold. The first, these earlier ones, those are the ones that are in ending inventory, right? So, Avery, should I go to somebody else? Yeah? You're tired of this game?
No.
Who wants this one? Which ones were in ending inventory? Kyle, you got it? Okay.
2,000.
Okay, 2,000 from March 2nd. They were at $4. Okay. And how many do we need in total? 6.
Then you use 4,000 for March 15th.
4,000 from March 15th, and
440.
those were at 440. So these 2,000, that's a total of 8,000, right? 2,000 times 4 is 8,000. 4,000 times 440 is 17,600, right? So that's a total of 25,600. Yeah. Total of 25,600 in ending inventory, right? Which means the total that's in cost of goods sold, how much is that, Avery, in cost of goods sold? $18,300. Okay. Now, let me just say that instead of subtracting that, what could we have done? For cost of goods sold, we need 4,000 in cost of goods sold. In, first out, it would be, last in, first out, it would be, these guys would be in cost of goods sold, right? We could actually calculate it all out. We could have calculated these numbers out, just like we calculated these out. Do you see what I mean? And that's what I normally do if I have time, is calculate both ending inventory and cost of goods sold, and that way you didn't just blow the whole thing by multiplying. Do you see what I mean? Are y'all following me on that? Like ending inventory, let's just do this one right here under LIFO. How could we get to this 18,300? Last in is the first out. The last ones in were the 2,000 at 475, which is a total of 9,500, and 2,000 at 440, which is a total of 880.
That's just a way to check your work.
Yeah. And see how that adds up? Which I think it's a good reason to do that. It also not only checks your math, it checks your way of thinking about things. Because first in, first out, all of this, Avery can attest that it gets kind of twisted around, right? As to which one we're doing, cost of goods sold, ending inventory, FIFO, LIFO, you could get turned around in circles, right? So I think it's good to do both ways. Really, maybe even just draw a circle around the ones that are in ending inventory and the ones that are in cost of goods sold or whatever, any way to make it make sense to you, okay? Questions about this part so far? FIFO and LIFO, does this make sense? Okay, let's look and see, in general, what has happened. In this problem, Avery, do we have rising prices or falling prices? Rising prices. Okay. In our period of rising prices, what's our deal? Which one of these is, what have we said? Cost of goods sold should be higher in LIFO. Is that right? Yeah? So cost of goods sold is higher under
That's it.
yeah, cost of goods sold. Cost of goods sold is higher under LIFO, so comparing all these numbers here, cost of goods sold is higher under LIFO, which makes net income lower under LIFO and taxes lower under LIFO, right? Okay, so we're not going to get to all we wanted to do today. I mean, at least all I wanted to do. We're going to work a couple of problems, and that would be on page 451. We're going to do another problem, try to hammer this home. This number 5. So Amsterdam Company uses periodic inventory. The way that we've been working these problems here is under the periodic system, that we wait till the end of the time to figure our ending inventory. The answers will be slightly different under a perpetual system, okay? So we haven't talked about that yet. But under a periodic system, Here's what has happened. Now, the first thing that I like to do, remember, is get this part down pat. What's happened here? Our beginning inventory is how much? $250. All right, our purchases, how much? So $750 for goods available of 1,000, right? For April, the company sold 600 units. See that? 600. Cost of goods sold. So our ending inventory is how many units? Jeremy? You got it? How many units? 400, right? Okay. So what we're going to be trying to do here then is allocate our cost between cost of goods sold and ending inventory, right? Okay. So what is our ending inventory under average cost? Average cost. Brett, you got it? You know how to do it? Okay. Here's our formula here. So our goods available in this case are how much? Units. Yeah, okay. Units are 1,000 units, and dollars is 11,850. So our average cost is 11,850. Are y'all following that? Okay, so we're going to use 11,850 to calculate cost of goods sold and ending inventory. All right? So our ending inventory, we had 400 units, and our cost of goods sold, we had 600 units, right? You see where we're going with this? So what you got, Brett?
For ending inventory, I got 4,740.
4,740, and for cost of goods sold, you have 7,110, and that equals a total of 11,850, right? Just like our total goods available. You just, this 400 times 11.850. Yeah, this is 11.850. Or 11.85, how about that? And same way with cost of goods sold, 600 times 11.85 is that, okay? That's the
11.85 is the average cost, right?
That's the average cost. Our average cost is the total goods available divided dollars divided by numbers. Okay. And the problem's going to give you the total goods available in one way or another. You might have to add it up or whatever. Okay. So now we're going to do number 6 and 7. We'll do FIFO. So in FIFO, do y'all want to calculate the ones sold or the ones in ending inventory? Yes.
Just a quick question. How did you get the cost of goods sold 600 in inventory for?
This. Okay, so they gave us that there were goods available of 1,000 here, right? And then right above that, it said they sold 600 units. See right above the thing? In the first part of the problem. First sentence, yeah. Yeah, they sold 600, so that means they had 400 left. Okay. All right, so FIFO. Let's calculate the cost of goods sold in FIFO, okay? We're going to calculate cost of goods sold in FIFO. In FIFO, the first ones in are the ones that we sold. And we want to come up with 600 of those, right? 600 of the first ones in. So where do we get that? 250 of those first ones at 10, right? Do you see where I'm going? Jeremy, are you following me? The very first ones, so we had 250 of those at 10, so that's 2,500, right? And then we had 350 at how much?
12.
At 12, so that's for a total of 4,200. So total FIFO is 6,700. That's the next units after the ones that we bought for $10 are the ones we bought for $12. We just needed 350 of those next units. See? Yeah, the first ones we bought for $10. The next ones we bought for $12. We bought 400 at $12. But we only needed 350 of them to make our total of 600. We only need 600 total for cost of goods sold. Okay, now we could recalculate this over here, which is what I normally do, but just for time purposes, I'm not going to recalculate it. I'm just going to figure, I know what this number is and how much is it. $5,150, because how'd we get that, Jeremy?
11,850 minus 6,700.
Right. The total goods available minus this is 5,150. Okay. All right. Now we're going to go to LIFO. Under LIFO, let's do cost of goods sold again. The last ones in are the ones that we sold. The last ones in, which ones were those, Jeremy? The last ones in. Yeah, April 23rd, we had 350 at how much? 13. So that equals a total of 4,550, right? How many more do we need? 250. And how much are those at? 12. So that's a total of 3,000. So that's all adds up to 7,550. And our ending inventory would be how much? Brett, are you the calculator guy? Okay. 4,300. Okay. And you got that by subtracting 11,850 minus 7,550 is 4,300, right? Okay. And like I say, we could calculate out these ending inventory numbers, but we're not going to do that. But you might want to just double check all that, right? Okay, so what we were going to do is we were going to do another problem. but I don't really think we have time for that. We were going to do problem 5. No, exercise 16. Just look at exercise 16. What about if I do this? What about if I give you, are y'all going to work this if I say this would be really good to work? We'll see. Okay, so ending inventory, I'm just going to give you the answers. How about that? The ending inventory for weighted average ending inventory is 3,080. Weighted average ending inventory is 3,080. FIFO ending inventory is 3,210. And LIFO ending inventory is 2,930. So if you want to, just see if you can get those numbers. And I'll give you cost of goods sold on all 3 of those too. Cost of goods sold weighted average is 7,150. Cost of goods sold on FIFO is 7,020. And under LIFO is 7,300. Okay? So just see how you come, see if you can come up with that, and that'll give you a good idea about how we're doing. Because we're going to have to go on to something else next time. And I wanted to go over this. Did y'all all pick up this on the way in? Okay, so we're going to go over the time value of money homework.